Have you ever wondered how can I lose £70 billion basically overnight? Well, this is the story of Enron. In the early 90s, they were one of the biggest US companies, and they lost it all because of a couple of very naughty turnips. By August 2001, Enron had become the 7th largest US company and had a worth of $70 billion. And in charge? Two very, very naughty turnips. Turnip number one was Ken Lay. He was the CEO and had been since 1985 when the company was founded. Then there was Jeffrey Skillett, who joined the company later in 1990 as CEO of a subsidiary called Enron Gas Services. But before we get too ahead of ourselves, how was Ken Lay making money in the first place? In 1985, Enron was founded with the merger of two companies, Houston Natural Gas and Internorth. And basically Ken Lay made his money by owning and operating natural gas pipelines. Now, by 1987, there was already some less than ethical behaviour happening. So, when two of Enron's oil traders were caught stealing money and moving it to fake accounts, naming them things like my arse, you would think Kenneth Lay would start an investigation and then probably get them prosecuted. But that didn't happen. Instead, an email would surface years later showing that Ken Lay simply asked for the traders to keep making him millions. Now, in 1990, Schilling joined the party, and his first move was to introduce the gas bank concept. This moved the company to start trading natural gas as a commodity. They would act as middlemen between the producers and the consumers, raking in profits from all the fees. They would also go on to start trading on the electricity market, broadband, and at one point they even speculated on the weather. Yep, they would bet, for an example, on what the temperature would reach on any given day. Granted, this does sound a bit crazy, but it was these kind of decisions that won them the Most Innovative Company Award. So, before we go any further, there are three key points that need to be understood. These highlight the core issues in Enron's financial practices that eventually would lead to their downfall. Firstly was the decentralization of the natural gas and electricity markets. This allowed a manipulation for profit approach. Secondly, there was the creation of special purpose entities. This created the ability to hide debt, giving Enron a clean balance sheet. And thirdly, mark-to-market accounting, which allowed them to hugely overinflate profits. Enron had successfully lobbied for the decentralization of gas and electricity markets. The monopoly was broken on the control of power generation, and so in theory the consumer would have cheaper energy because the energy companies could be competing, and this would create more competitive rates. Sadly, all that happened was once Enron had more control, they started to illegally manipulate the markets for their own profit. Alongside this, the SEC approved mark-to-market accounting. This meant once they had created and signed off on a project, they could put the predicted earnings on Enron's balance sheet immediately, even if no money had been exchanged. There were even examples where deals later fell through but the predicted profit still remained on the balance sheet. To top it all, I've left the most special turnip till last. This is Andy Fastow. He joined the company in 1990 and was appointed CFO in 1998. He created what's called special purpose entities. Basically, these are shell companies that can move underperforming assets, failed ventures, and any other debt that the company had created into. The key point is, once these liabilities had moved, they didn't need to legally show them on Enron's balance sheet anymore. And it was these financial practices that marked the end for Enron. Flash forward to October 2001, the SEC, slightly late to the party you could say, launches an investigation into the special purpose entities. This then forces Enron to declare their first ever quarterly loss of $638 million. In turn, investors start running for the hills. This news spreads like wildfire, and Enron's stock value goes from $90 a share down to 90 cents a share. And it's game over. Enron has no choice but to file for Chapter 11 bankruptcy. Now, what do you think happened to the three naughty turnips? Well, long story short, there was a lengthy investigation and ultimately they were arrested. The trial started in 2006, where Ken Lay was convicted of 6 counts of fraud and conspiracy. He died in prison of a heart attack before sentencing. Andy Fastow was convicted of 2 counts of wire and securities fraud and spent 6 years in prison. And finally, Jeffrey Skilling. He had the harshest sentence, convicted of 19 counts of securities fraud, conspiracy and inside trading. He spent 12 years in prison. And there you have it, a proven template on how to lose $70 billion. My advice, don't be a naughty turnip. If you have made it all the way to the end, thanks guys for watching, and don't be a turnip. Go on, subscribe.